Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from Chartsandmarkets.com runs down the major markets. December started out strong but cooled off as the new year approached. He checks out gold, crude, and currencies. Publisher of Rick's Picks, Rick Ackerman, believes the markets will be tricky in the new year. He calls Tesla an idiot stock, with used Teslas finding few buyers. Rick has a special offer for our listeners. Author of several books on the economy, including The Money Bubble, John Rubino, takes a look at the new year when it comes to inflation, gold, silver, commercial real estate, and AI. Founder of the Schachter.Energy report, Josef Schachter, checks in from Calgary to discuss energy likelihoods under a Trump administration, the possibility North America is in recession, and whether energy prices will bounce back. He also has a special offer for our listeners. We'll talk to Ross Clark right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from Chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to the show.
Good to be with you for the last time this year, Jim.
Yeah, talk to you next year.
Yes, it's turning into a bit of a choppy phase as we finish off the year. December started well. I guess this is a bit of a continuation from the November election in the States, where everything came to life. But, we got into the first week or so of December, and the items that had been really hot looks as though the fund managers and some of the big speculators are taking some money off the table. Been some huge runs, when you look at the year as a whole. So I'm not surprised to see that, we usually are looking for opportunities with tax loss selling, but in this case, you've got to keep your mind looking the opposite way to think of, who's taking money off the table. And, it's the big names. It's the Netflixes, the Microsofts, Amazon, Tesla, all peaked out about just over a week ago and starting to have some corrections here. And, that wouldn't be at all surprised that the first calendar quarter of 2025 sees more of a sort of choppy action with tests of the uptrend as far as those stocks are concerned. And on the other side of the coin, the area that really has had a very poor performance has been over in the energies. And we have the XLE, which is the ETF of the oil stocks. And so that's your Exxon, Chevrons, the Verins. Those are all now very oversold. We've got capitulation signals in the last 4 or 5 days in the stocks as well as the ETF, and starting to see a little bit of a bounce right in the last couple of days here of this week, but looks as though could be a decent bounce as far as the energy stocks are concerned. Now it would be apropos here for them to have a bounce but go down and test the lows, because they have a tough time moving up independent of the stock market. If you look at the S&P and the XLE, they're pretty much an overlay of one another 90% of the time. So for the XLE to really have a big move on the upside, I think you'd have to get a decent correction out of the way as far as the stock and the overall market is concerned. So there's probably a short-term trade there in the energies, and if they go down and test the lows, and if oil goes down and takes out, gets down into the mid-60s, then we can be looking at a nice seasonal run off the bottom. But for now, it's a trading opportunity.
Is oil down due to a lack of demand in Asia, in China?
Well, I mean, the Chinese things have been slowing down as far as the economy is concerned over there. But you look, they're doing what they can to try and stimulate. I mean, take a look also at the Japanese. There's talk there in terms of interest rates, the movement possibly over there. There's lots of discussion in the background as far as what might affect the markets. I really find that by the time there's a consensus on the fundamental side that whatever story it is getting long in the tooth. So me, I look at the chicken scratches. I look at the charts themselves, and if they give me some guidance, ideally I want to find some overextended markets that then don't move any further on news. You want to, when you've got really negative news out on something and it doesn't go down, I mean, look back to the uraniums 3 or 4 years ago. Everybody was bad-mouthing the sector. And, look at the move that we've had. It's been a phenomenal move on the upside. And then middle of the year, people got excited again, and uranium was once again a favorite. And guess what? Ran out of steam, and it's having a correction right now. The uranium price has given back a fair amount off the top. The stocks are starting to hold in. So I'd be looking at that as another sector, as well as the XLE over in the energies that would be a favorite item for 2025.
What's going on with gold?
The gold market, good bounce off the 20-week moving average. It really, at this point, is not. I don't think it's ready to take off. The seasonals are positive in here, but it's still looking a little bit heavy. I think that so we're sitting around 2,600 on the cash price. The best support would be down around 2,450, and I wouldn't be surprised. That's the 50-week moving average, and when you've had a move of the extent that gold has had here in the last 2 years, you got to remember this was a $1,650 item 2 years ago now, so it's been a sizable run. Corrections are just the norm, within bull markets. So I think if we can get a deeper correction, I'd be really excited about that. If it decides it wants to break out through the 2,700 and maybe 27 and a quarter, it could be on its way. But I'm from Missouri. I need to be shown what it's going to do, and at this point, the only guidance I have is looking at where the short-term support is, and if that gives up the ghost, then the deeper correction wouldn't be at all out of line.
What's the story on the currency front?
Currencies, the U.S. dollar has been once again, the strong item out there. We're sitting 108 on the index. Looks as though it's probably got maybe one more push left in it here. We've had some, a couple of big upside surges. The first one in September, then another one mid-November, and then right into a week ago. Starting to lose a bit of momentum here, so you could see one more push to the top. And if we look at the other currencies, they're getting overdone on the downside. So a reversal in the dollar index wouldn't be a surprise. We look at the Canadian dollar because that's where I'm seated right now in Canada, and the dollar has been producing the type of oversold levels that you own very infrequent. I think you got 14 of them in the last 30 years. What you need to see is a catalyst on the upside. And so the first days with higher highs would be, in my mind, the turn that we'd be looking for. And it could be related to politics. Clearly, if the world starts to look at us as on the verge of a change of government, that may be the catalyst that gets things moving. So it's oversold enough that it could be a decent rally. So catch the move as it reverses. If you're really gutsy, then maybe you take a position ahead of time, but I'd like to see a bit of a reversal to the upside before I get on board.
Bitcoin below $95,000.
Yes. This one, we got good upside readings there when it was up at 100,000, overbought readings, and here we are right down back at support. This is the same level that now we've been at been down to a few times in the last month. It's looking, at this point that it's a bit heavy. That was what you would call then a false breakout, an upthrust failure when we had that short-lived move to 100,000. And I think that you could end up with a deeper correction, maybe down into the 70 to 75,000 area.
Ross, thank you so much for the update and the best for the new year.
The best for you and all the listeners then, Jim.
My guest has been Ross Clark from ChartsandMarkets.com. Find him on X at Charts by Ross. Coming up, Rick Ackerman, next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Rick Ackerman, editor of the newsletter Rick's Picks. His website, rickackerman.com. He's speaking to us from Florida. Welcome back to the show and Happy New Year.
Happy New Year to you too, Jim, and thanks for inviting me on.
Rick, you have a special offer for our listeners. Can you tell us about it?
Well, if you go to rickackerman.com, up top there's something that says, there's a tab that says free trial. And if you just click on free trial, you'll get a couple weeks of Rick's Picks for nothing. You don't have to leave a credit card number. It's just no strings attached, and it will give you access to everything. You can come into the chat room, the trading room, where some of the best traders that I know hang out, and they're a very affable bunch. They share great trading ideas in real time. We've got a few certifiable experts in Bitcoin and also in bullion, gold, and silver. And there's the list of symbols that I track that are meant to give a pretty good overall picture of the market. Things, popular vehicles like the E-mini S&Ps and gold futures, crude oil, Bitcoin, Microsoft, and a couple others. And in many instances, there's actionable guidance in those touts. So you get access to all of that just try it out for a few weeks for free and no obligation. That's rickackerman.com, and just click free trial up top.
Let's talk about healthcare, where RFK Jr. is teaming up with President Trump to make America healthy again. Is there a bearish signal for big pharma?
They're too big, I think. They're almost, we speak of the banks as too big to fail, but the drug manufacturers are too big to wound. They can't be. They're impregnable. And you get a sense of how big they are if you just watch primetime TV and count the number of drug ads that you see. And RFK, it's a very interesting, we're at a very interesting point, because most Americans understand that Big Pharma is out to, they're really out for themselves and to make as much money as they can. And of course, that's a corporate prerogative. That's capitalism at work. But Big Pharma has evolved in an interesting way so that they can sort of shove pharmaceutical answers down your throat. And the whole idea that TV advertising should create demand for certain drugs before your doctor even recommends them for you. You know, it's supply side. It's a supply side industry. They've got stuff they want to sell you, and screw the doctor. Most of the doctors they bought off, and even though we purport to regulate that, just how many goodies and trips to the Virgin Islands and to Italy that they can give the doctors. No matter how we purport to restrict that relationship, it just happens. The drug makers are so wealthy that they can buy the land, sea, and air, and you can't escape their promotions. So RFK is stating the obvious, and to put it in as succinctly as possible. He says we're all dying of cancer and obesity-related diseases because our diets are all wrong and we're not exercising enough. And you have two choices. You take pills so that you can continue to have a lifestyle that kills you, or you can get healthy. So RFK is proposing the simple answer of we just need to develop healthier habits. And of course, there's that other part of what RFK is saying that scares hell out of the industry and the establishment and the mainstream media, and that is we should put people like Fauci in jail. So that's sort of the hard edge of what Kennedy is saying. There are a lot of people who are criminally responsible for America's poor, literal state of health. And it'll be interesting. You might look at RFK as it's a case of the irresistible force, a guy who really wants to come in there and make changes that have broad consensus support versus the immovable object of an entrenched pharmaceutical industry. So there's going to be a lot of conflict there, but I don't think I would short the drug stocks quite yet. But Kennedy, he seemed like a real dynamo, and it was a very aggressive activist choice for Trump to make to put Kennedy in charge.
The Biden administration has given the COVID vaccine makers immunity until 2029. Should this need for immunity be a concern for big pharma shareholders?
Yeah, and see, everybody understands that stinks to high heaven, that whole idea that the drug manufacturers were exonerated from any risk of this untested, other than by computer, experiment. And if you sort of take the things that someone like, let's say, Robert Malone says, that the vaccine's probably going to wind up killing more people than it didn't save anybody. It really didn't prevent COVID, and it was, if you want to call it a vaccine, it did a pretty lousy job at vaccinating. So we have to, so everybody knows that's going to be political hell, really, to navigate those shoals that the drug makers have been completely, and legally they have a pretty good argument to make. They can say, well, the government they told us to get these vaccines. They don't put quotes around that word like so many of us do, but they were told that to get this vaccine out on an urgent basis. And of course, it was the national emergency aspect of the vaccine that put into play legally this idea that they should bear no responsibility for however many deaths they're going to wind up causing. But it could be in the many millions, really. We've seen the drop-dead phenomenon among some young, very fit athletes, and there are so many cardiological problems arising from the quote-unquote vaccine that even now you can see that the liability it'll be enormous. It's beyond imagining, really, because it's going to involve the death of a lot of people and the impairment of whole lives for 20 or 30 or 40 years. So legally, in terms of tort claims, it's probably the biggest issue that's ever come before the courts, or is yet to come before the courts. In dollar terms and in terms of human suffering, this is the granddaddy of all claims and of all torts, and of course the drug manufacturers can just sort of wash their hands of it, at least now in theory.
Is JFK Jr.'s involvement likely bearish for the makers of processed foods with ingredients that are toxic to the human body, including seed oils and sugar?
Well, that's a big issue too. If you accept the reason we've made no strides against cancer, other than that there are better treatments for cancer and diagnostics are better and survivability is better, but we're certainly in no way, shape, or form beating cancer. It continues to it's still epidemic, and if you go to the idea that the one thing that is common to our diets is seed oil, processed oils have to be a major cause of cancer. When you eliminate them, or let's say seek to eliminate them, you're talking about turning the U.S. food industry upside down. And the only way we can evolve beyond the problem, of course, is to have local growers provide organic food, and everybody, of course, goes to the farmer's market, and they cook with fresh ingredients. But you can imagine if we were doing that tomorrow, how much that would reshape the way food is sold and prepared. So that's a huge thing, and only so much can happen under Trump and his appointees, but that's just one gigantic problem of retrieving a healthy diet for Americans. It's Kennedy is the guy for the job, but how he's going to do it, it may be beyond the ability of one man in one age. It may take 50 years to bring it around, assuming Americans get with the program.
Is RFK Jr.'s involvement likely bearish for the agriculture companies that make pesticides?
You say bearish, but you're really just you're implying kind of a time frame for stocks. Do we short the stocks, or do we? I would say at best you can avoid certain stocks because they're going to be going up against a tide, really, or a tidal swell that some guy like RFK may be the very beginning of. So no, I wouldn't look at Fauci as bearish for drug stocks or bearish for food processors and distributors or sellers. The sellers are least exposed. They have a way, like Whole Foods, for instance, of sort of going to local growers and getting healthy in their own way. But the bigger changes that will come from the top, or to an extent, they'll be pushed from the bottom up because people are, I think, adopting healthier eating habits. It hasn't quite spread into, I don't know. I was going to say exercise, but so people make choices, and I think that can reshape the system itself. But to reshape it from the political end, driven from top down, is going to take decades.
Are fast food chains likely to make the food they serve healthier?
They can't really. I mean, if you talk about, with McDonald's, it's like a big deal when they're bored, when they're discussing modifications in the quarter pounder or whatever, just to get an extra slice of pickle or take away, instead of using, let's say, degassed onions or things like that, instead of using processed condiments to use fresh. That's an enormity. They're huge. They can't make money at it, number one, because the business is so competitive. So I guess the handwriting's on the wall for fast food. The restaurant business is going to have to get healthier too, and in terms of what they serve, but it's impossible because the margins in the restaurant business are so low that they don't really have the money to experiment and to buy higher quality ingredients. So But in that respect, the food business is no different from every other business, mega business in this country. There's no money in making things better. There's no money in improving. At the margin, there'll be a few operators that attract the high end. They have higher prices, but they deliver a better quality of goods, Food or it could be even in the tech area. It could be everything you use in your home. But there is the basic problem is that we're a big business runs things, and we get what we perceive as better value, with cheaper prices. It's the difference between shopping at a nice grocery store or getting all your food at Costco. The amenities are somewhat less extravagant, but by and large, all the incentives for companies that make and sell us stuff are skewed toward extracting the last dime of profit, of creating higher margins, so that we're only going to get more and more crap. And Charles Hugh Smith, a colleague of mine who puts out, he's a blogger with Of Two Minds, he's written brilliantly on that subject of how the I guess you could call it the crapification of America. But the basic point is there's no money in improving things. That's why everything pretty much, and just go down your own checklist in your own life, but pretty much everything has gotten worse over time. And it doesn't matter what we're talking about, whether it's the quality of the computer applications that we use, of customer service, of manufactured goods. Everything keeps getting worse because there's no incentive for a company with these bigger and bigger companies that dominate. They're called category killers. They've sort of got the market sewn up, and that's the way all business is trending. So what incentive do they have to improve the product? So they do the opposite. They continue to make it cheaper and cheaper and cheaper. Just if you like Oreos, just look what's happened to the Oreo over the last 10 years with the move to manufacture Oreos down in Brazil, and so that the white cream it's no longer white. It's more like an off-white, and it doesn't taste like cream. In fact, it doesn't taste like anything. And the distinctive sort of chocolate-like flavor of the wafer, that's gone too. The wafer has no real flavor. So the Oreo would be a perfect example of how everything is tending toward crap, and there's just no escaping it. It's part of the bigness of rolling up of smaller companies into larger. And whatever the smaller companies were doing well, that will be abandoned when the bigger takes them over.
Is it time for a large overhaul of the medical industrial complex?
It's unreformable at this point. You know, I have a good friend of mine who's staying here in Florida with me for the holiday week. He's a physician, and it's gotten so much more difficult for him. I think he's got to see 22 patients now a day. He's working. He says he's working harder than ever to make less than he ever did, and that has to do with the reimbursement rates. And of course, Medicare dictates what happens in the privately insured sector. So Medicare has been and will become an increasingly ruthless actor to squeeze out the last ounce of savings from all procedures. But a good example of the crapification of medicine, healthcare, would be telemedicine. You know, the system, the big players, and even with the complicity of the federal government, would have you believe that if you get together for 12 minutes on a screen share with your doctor, that's a real doctor's appointment. But in fact, I was talking about this yesterday with my friend. When you go in to see the doctor, he's a good doctor. He's observing a lot more of you than he can see on a television screen, and then he's not getting your vitals, not enabled to check your blood pressure and do this and that. But that's horrible. That's just crap medicine. But it's being sold to us as, well, here's an area where technology allows us to get together with our doctor without the inconvenience of going to see him at the office. But that's a dirty, rotten lie, and that's one way that medicine is being crapified. The other part that we were talking about yesterday, it's really interesting, but there's sort of this is difficult to talk about, but America is somewhat divided over the assassination of that United Healthcare executive. Not that anybody's out there rooting for the cold-blooded murder of corporate executives, but in this case, one side makes the argument that the executive was representative of denial itself. Anybody who's had a claim denied, well, it eventually goes to the authority, the oversight of somebody like this CEO. And but the denial of certain procedures is becoming more and more entrenched in medicine, so that the longer they deny you, the more money they're going to save. If you need an expensive, and one particular area that's been affected is MRI scans. They're more involved, more expensive than CAT scans. So MRI scans, which can be life-saving because once you have a good diagnosis, you've got a pathway to a cure, to a treatment. So it's MRIs are being denied more and more. And from the standpoint of the insurers, the longer they deny, the more money they make because, number one, more people will die waiting for whatever the procedure the MRI would warrant. And so the denial is sort of they'll say, and they'll waste money. They'll say, well, look, while we're talking about this MRI, we'll put you through a physical therapy regimen. And my friend is a sports medicine doctor, and he sees that as a complete waste. The idea of taking someone before they can get the scan, the diagnostic, and just putting them in a PT regimen. That's not only just a complete waste, it can be counterproductive in terms of what happens to the patient. So here we got CEO of United Healthcare gets shot to death, and there are a lot of people out there who are sort of on the side of this whole saga that says, hey, this guy, he had it coming to him, or he, symbolically speaking, he was a good choice for assassination because he represents this the whole trend toward claim denial. But it's coming in such a huge way, and I hate to think that it's going to result in a lot more assassination, but we're triaging medical care right now. It's in everywhere you look. The crapification goes to the fact that there's not enough money. There's not enough money. There seems to be, because the stock market is at these absurd heights, but that's all going to end with the bear market, and when we're not sort of leeching, we're not sort of taking from the fatted calf to make our medical system appear viable. It's not. So if you were to sort of put it in a paradigmatic form and say, this is a question that I've asked before in discussions we've had. The question is, do you honestly believe that millennials and Gen Xers and Gen X and Gen Y who are living in their parents' basements till they're 35, do you think they'll be able to foot the Medicare bills? Let's not even talk about Social Security, but do you think they'll be able to foot the Medicare bills for the baby boomers? And of course, the answer, we're not even close there. So medical procedures are going to be triaged. We're going to get less and less of them because they're less affordable, and the only way to do that effectively is through the mechanism of the denial that this United Healthcare executive represents symbolically. So, and not just symbolically. I mean, he's the guy with the authority to dictate policy with the assent of his handpicked board of directors. So yeah, we're going into an era of denial in medical treatments and diagnostics, and there's nothing we can do about it.
There's discussion on the internet that most or all diseases are actually parasites. If this is true, what could happen to the healthcare sector?
Nothing. No one's going to prove that in such a decisive, definitive way that it's going to change anything. I mean, it's an interesting theory, and we've got all sorts of cool ideas that something or other is diabetes type 3, Alzheimer's or Parkinson's or whatever, and we're getting all this redefining, but I think that's just people out there screaming for attention with some novel idea. But by and large, the medical apparatus that exists, the way we treat things, even the way we regard disease, it's pretty well entrenched, so we're not going to sort of move over to some big new idea.
Could we see a transition from allopathic medicine to natural medicine?
I think that's a natural progression. One area where we've seen it in a way would be with chiropractors have become popular because the orthopods simply don't get results. There's some good guys out there, and they can treat you and fix you up, but a good chiropractor, and I would say 90% of them are quacks if my own experience is representative, but the 10% who know what they're doing, they deliver relief for your back pain in ways that the MDs cannot. So I think people are going to move toward other treatment and diagnostic modalities, and of course you've got to get past the insurance companies on that. But in many cases, we're already getting it where people that they don't get it through their insurance; they simply pay for it, but they're getting superior care with naturopathic.
President Trump's been hinting Canada should become the 51st state. What are the pros and cons of that?
I would do that as long as anything connected with Trudeau isn't part of the package. But of course, that's a joke anyway about Canada being the 51st state. You guys are simply up there, not really causing us much trouble. Although it's hard to believe some of the things that Trudeau got away with. I mean, you elected him, so I don't know.
Overall, are you bullish or bearish on 2025?
I think that the whatever black swan ushers in the second Great Depression, that could happen this afternoon. It really could. The market is so ready to collapse, and of course, I've been a collapsitarian for a lot of years, and the market has just kind of outdone my imagination there. I never would have thought that the level of delusionality could get to where it is. I thought we kind of had it in 1991 when we were dealing with the piddly-doodle numbers that had associated with the S&L crisis, but that was just hundreds of billions of dollars, and we're so far out of that league now. So yeah, I would never take a shot at 2025 and say it's going to be a great year. It could be in terms of this wealth effect illusion. Stocks just keep going up simply because there's all this foie gras, shove it down the goose gullet money out there that comes from corporate buybacks of companies buying their own shares back, but the flow of money, let's say the distribution, the allocation of money that would be the baby boomers' nest egg, that can change just for psychological reasons. That's what deflation is. People think, well, everything's going to be cheaper tomorrow, so why buy it today? So another way of looking at that, when you hear this stupid idea that there's all this money sitting on the sidelines ready to come in the market, well, that's a lot of crap. The money on the sidelines is money of the mind. It's the expansion of credit simply because people think they're on the upslope, that everything they buy is going to increase in value. But there is no money on the sidelines if the psychology changes, if people see that they're on the downslope or they're worried that they might be. So all that supposed money on the sidelines, it doesn't exist. It's a creature of the mind. So it's impossible to say what event would cause a sea change in people's idea about being on the upslope or the downslope. But I think at best we're at the top of the mountain, really, and we could stay there. It could be a while before we start on the decline side, but you're crazy to think that it couldn't happen tomorrow.
As we're speaking, the stock market boards are outlined in red. That's not usually a good thing, but did we have a really good run up till now? But are we getting sort of a black message going into the new year?
Well, hard to read too much into it. The market is going to be tricky. I got a little too tricky myself and put out this contrarian idea that the market would fool everybody and collapse at the very height of Santa's season. But, of course, it did not. Seasonality right now is at gale force, pushing stocks higher, and you don't find much. There's not really much selling out there. It's all the chimpanzees who run money, the portfolio managers who have their kind of buy and hold strategies in 7 stocks. But the market is very, very narrowly focused in just a small group of winners. And if you X out I call it the lunatic sector, but it's been misnamed the Magnificent Seven. Not quite sure what's so magnificent about just the wholesale inflation that's taken place in those stocks. But if you take the market as a whole and strip out the lunatic sector, many stocks are in bear markets. And that's relative to even the 200-day moving averages. By certain technical indicators, we're already in a bear market, except for a few stocks.
Those big stocks, should people be bailing on them?
Yeah, they should. One example, Tesla, for instance, is on the face of it, it's just an idiot stock. You really have to be a complete idiot to buy it because everything is going against the EV market. For Tesla, you've got an onslaught of competition from China, and Lord knows they'll be selling EVs for $8,000 before the war ceases. And of course, China has a huge domestic market that it can essentially require to buy EVs in ways that cannot happen in the U.S. It turns out a lot of motorists are having second thoughts about switching to EVs, and regardless of what their thoughts are, we're coming up at a point in the product cycle where we're going to have to start thinking more seriously about what do we do with all these batteries. So the market for used Teslas is absolutely headed into a collapse, and that's going to drag down the sales of their newer models. So there's some very disturbing things that are developing that are going to be right in our faces that come from the product, the life cycle of the EV. And here we've got Tesla stock. It's been up until very recently, it's been in a vertical climb. So and that's simply because Musk worship is at an all-time high. I love Musk. I think he's great. I think he's a true American genius, even though he's Canadian. And but he can't be everything to everybody. But Musk has gotten such enormous attention, and the idea is that his buddy Trump will fix things so that the production of Teslas has an edge over all the other EVs. But that's not going to happen either. Musk will face kind of natural problems that I was just mentioning, and so Tesla is really the stupid stock. The higher it goes, the stupider you have to be to buy it.
Should baby boomers be bailing from the stock market or a portion of it?
Well, that's where the pool of savings is right now, and there we've got Tesla demographics too. We've got the whole baby boomer generation. It turns out that they did not all sell their McMansions and move into smaller homes because the smaller homes don't exist, and where they do, they cost just as much as the big homes that they're giving up. So the baby boomers are essentially staying put in these overly large homes, and whenever they tote up their retirement nest egg, they always include the equity value of their homes, but that's very that's not very good thinking. It's they're not all going to be able to cash out for $800,000 to $2 million, so they may as well write off the equity value of the homes. So by and large, though, the baby boomers have done like everybody else in the market. They've done phenomenally well in the past year. I have friends who made 40% on their money, and even though I think most of them sense that at these heights the market is pretty risky, it's hard to justify taking money that has been effortlessly generating a 40% return and putting it into Treasury bills, for instance. Well, that would be one way to get your money into safety, but they're yielding something like a little more than 4%. So, and also most of my baby boomer friends, they think and they've been assured by their financial advisors that 2025 is going to be a great year, probably as good as 2024. But we know that annual returns of 40% are not going to last for long. So that's a big problem. The money should be coming out now, especially in the lunatic sector stocks that have performed so well in the past year.
The collapse of the commercial real estate sector, I haven't heard a lot about it, but you said it's something that's being conveniently ignored.
Yeah, when you have the stock market going bananas, it gives you the leeway, the slack to not much talk about the elephant in the room. And this is a very large elephant. Commercial real estate in all the big cities is in big trouble because with interest rates going up, the cost of everything in commercial real estate is increased. The cost of maintaining buildings, of, let's say, refurbishing them, but just to service the loans that buy these buildings is becoming more difficult. So a lot of commercial real estate is, I'm going to say marginally profitable, but it's not even that good. And you've had markdowns in San Francisco, for one. I think we talked about this. There was a building that had been acquired for $40 million, and it had over the years risen in value to be carried on the books at $110 million, I think. Or no, actually, it was valued at $150 million, and someone came along and they actually bought it for I'm just trying to remember the prices, but it came back down to $40 million or so. And the guy who bought it said, well, AI is going to fill up these office buildings with AI knowledge workers, and it's going to bring San Francisco back, but he's delusional. So anyway, we've got this huge problem with empty office buildings, and occasionally the spinmeisters will float this story. The Wall Street Journal is a very reliable shill for the commercial real estate business. So you read a story in there about how some savvy operators have bought super high-end buildings, and they've outfitted them in ways with gyms and nice rooftop restaurants and things like that, and that they are getting pretty good rents from those high-end buildings. But the journal is trying to sell that as the beginning of an upturn in commercial, but it's not really. It's just a relative handful of operators who are at the high end. They're attracting what few new tenants, big companies that think, well, let's locate in New York. And you can imagine how many of them are out there. With the things you read about New York City and what's going on at street level, it gives you some idea of how many executives are coming up with this genius idea about, hey, let's relocate our office to our headquarters to one of the most expensive cities in the world where people get robbed on the streets and they don't even use public transportation. So the journal sells the story as a recovery, just a glimmer of recovery, but it's not. There's no recovery going on in commercial right now. And and a whole other sector of the commercial real estate area, shopping malls, you can see an interesting solution at work. It's not going to solve the whole problem, but they've done, I guess, the obvious. The only thing they could do with mall properties, fixing them up so that they become mixed residential and commercial. And the Journal, again, is the top shill for this kind of story, and they'll say, hey, just check out what's happened to the mall business, and this is the mall of the future. It's really residential, but with the stores all close by, and movie theaters, as though movie theaters are not going to cease to exist. So they're selling the story as we're just redoing all the malls, but that goes about an inch deep. When you think of the number of people who meet the Wall Street Journal the standards of their story, like we've got this flourishing little metropolis with mini metropolis with wealthy tenants and high-end stores, that's good for maybe 2% of the whole of the problem. But for the most part, if you think it through, fixing up the malls to provide quote unquote affordable housing, what you're doing is you're sort of, if you're not remodeling the mall so much as you're bringing back the days of Pruitt-Igoe and some of the big housing projects that later became known as the quote unquote projects, which were eventually torn down. So there's really not enough high-end shoppers to go around to convert all these malls into mixed use. So in the same way that the office towers are undergoing a slight conversion, they're attracting some tenants. It's the same way with the shopping malls. Some of them have attracted distressed buyers, and there's let's say a very small, very modest improvement going on there.
Rick, thank you so much for chatting with us.
Well, thanks much for inviting me on, Jim. I really always enjoy our conversations, and I want to wish you and your audience a happy holiday season and a happy New Year and a good, healthy, prosperous 2025.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks. He was speaking to us from South Florida. His website, rickackerman.com. Coming up, John Rubino, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is John Rubino, author of several books on the economy, including The Money Bubble. He founded the website dollarcollapse.com. You can find him on Substack at Rubino.substack.com. Welcome back to the show, and Happy New Year.
Hey, Jim. Yeah, almost 2025. Amazing how fast last year went, huh?
Yeah. What do you expect for 2025? Will central banks keep easing? And if so, how far can they go?
Well, they're facing a dilemma right now, most central banks around the world, because inflation has been trending down for most of 2024, but now it's kind of bottomed and started to trend back up. So you've got rising inflation that's above, for instance, the U.S. Fed's target range, and you've got equities at all-time highs, home prices at an all-time high, and lots of other things out there that are actually pointing towards Feds or central banks tightening rather than easing. So they really want to ease because they're afraid of setting off a gigantic financial crisis, but I don't think they can. And you saw that with the Fed just at its last meeting, where Jerome Powell, the chairman of the Fed, came out and said, we'll probably cut interest rates again in 2025, but not as much as you expect. And therefore, rates are going to stay higher than the markets might be expecting right now. So, get ready for that to be a theme in 2025. Interest rates higher for longer until something breaks.
Can the equities bull market continue from today's high levels?
Well, see, that feeds back into interest rates because equities like easy money, obviously, because when a central bank pumps a bunch of newly created currency into the financial system, it goes to the big banks who give it to their favored rich customers who then buy assets like real estate and equities with the money. That pushes up the price of assets, including stocks. So you need easy money for an equities bull market to really keep going. And if we don't have that, if we have higher interest rates, that's a huge risk for stocks because they're at priced for perfection levels. And this is apparently going to be an imperfect world in 2025. So I think there's a very good chance that equities tank in the coming year. We get a rip-roaring bear market. And that sets the tone for a lot of what else happens in the financial world.
Will home prices rise or fall?
Well, house prices are in the same boat as stock prices for the same reasons. Easy money feeds capital to real estate, which forces up real estate prices. And you've got that happening in at least the U.S. housing market, and I guess Canada's housing market too, right? You guys have a bubble of sorts going on with super high house prices. Same thing in the U.S. House prices are as expensive as they've ever been, even more so than during the 2005 to 2007 real estate bubble here. And they are starting to roll over, house prices in the U.S. And there's no reason to think they don't keep declining if interest rates stay where they are. Because, you take house prices that are at record levels, especially in relation to wages and salaries, in other words, to purchasing power. You combine that with mortgage rates that were once 2.5% and are now 7%, and you get massive unaffordability in real estate. So, yeah, I think house prices could easily fall by 40% to 50% in a lot of the hotter U.S. markets right now. And they could do it in a very short time just because nobody other than, private equity groups are able to buy houses right now.
Where does gold go from here?
Well, gold is a tricky one because it's had a nice run. In 2024, gold is at more or less an all-time high in the U.S. It's slightly off. It's 2024 all-time high, but still $2,600 an ounce is a high level for gold. Now, right now, we're heading into the seasonally good time for gold, so it's reasonable historically to expect the next couple of months to be good. But I don't think gold is immune from an equities bear market. So if you get equities and real estate tanking, that probably pulls down gold and silver in response. That's the way it happened in 2008, and that's the way it happened in 2020 when equities bear markets led to precious metals bear markets. So that's a possibility out there. Now, the other possibility is that gold looks ahead. When equities start tanking, gold owners and gold traders assume that the big central banks are going to have to aggressively ease because they're terrified of what happens if they let an equities bear market just run wild. And so that's, aggressive easing is good for gold. So it's possible that precious metals will look ahead to that. So either they get a small decline and a nice bounce, or, an aggressive decline, but that is a V bottom where it bounces right back off, or nothing at all. Maybe it keeps going up from here. Any event, I think 2026 is probably a really good year for precious metals because by then central banks will be in an aggressive easing mode. So precious metals, I would say, don't jump in with both feet right now in anticipation of another run up above 3,000. We could easily see that, but there are possible corrections out there along with that nice run to higher levels. So keep on doing what you should have been doing all along, which is dollar cost average, or use low-vol bids or things like that for gold and silver mining stocks. Don't be super aggressive, but continue to add and expect $10,000 gold at some point as this cycle really plays out. So it won't be such a big deal whether you miss the run from 26 to 3,000 as long as you continue to add along the way to 10,000. So I think that's the highest probability scenario for gold.
Is silver still a monetary metal, or does it now depend on industrial demand?
Well, industrial demand is a phenomenally good story for gold or for silver because there are so many things out there that require silver, like solar panels and electric cars and next generation computer chips. That demand that at least equals and probably exceeds mine production of silver is probably baked into the cake going forward. So that's right there. Even if silver was just an industrial metal, it would still be an undervalued asset that would be worth buying here. But silver is also still a monetary metal in the sense that people equate it with gold. It's not going to be the basis of the monetary system going forward. We're not going to be on a silver standard or anything. But people who look at gold and see how expensive it has become tend to then look at silver, which they put in kind of the same category, and notice that silver is very cheap compared to gold right now. And so they tend to buy. That's how precious metals bull markets usually work. Gold goes first, silver then catches a bid and really outperforms gold for a while. So I would say the later stages of this precious metals bull market will be one in which silver, in part because it's a monetary metal still, dramatically outperforms gold. So it's definitely something, again, to be dollar cost averaging into right now, not aggressively, because we don't know what this year ahead is going to hold, and it could be really dramatically bad. But continue to buy on the assumption that when gold goes to 10,000, silver goes to 100 to 150 to 200, somewhere in that range. And you'll be very glad you were dollar cost averaging back here.
The incoming U.S. administration has some big plans. How much will they get done?
I think they'll get some done. Excuse me. But the way politics works is you start with aspirations and you end up with compromise and nobody's happy, and that's the best you can hope for in a democracy. And we'll get there for most of the Trump administration's big plans. But I think the incoming administration has enough of a mandate that a lot of what it wants is not out of the question. It could cut a good deal on a lot of the different issues. And what we're seeing right now with Trump, where we're going to, make Canada the 51st state, and we're going to close the borders and send 3 million or 5 million people out of the country in the first year, and on and on. There are a lot of things he's talking about that sound incredibly extreme and have a lot of people kind of freaked out, but are actually, with the exception of making Canada the 51st state, actually, let me digress there for a second. We elected a real estate developer, so it should be no surprise that he's looking at acquiring new real estate. And the whole Greenland thing is actually, who knows? That might be a possibility. There might be a price at which Greenland is available. So don't be super surprised if we do a big real estate deal in the coming few years. Now, with the other stuff like mass deportation and what else? Cutting $2 trillion out of the annual budget for the federal government. Those are things that, there's a good reason for us wanting to do them. And what we're seeing now is Trump's opening offer in a process of negotiation, because that's also how he does his real estate deals. He comes back with comes in with ridiculous demands and offers, and then including lawsuits. And then he eventually works his way around to a compromise where, he gets a good deal, but it's not the phenomenally good deal that he was trying for at first. He's staying with that same pattern. So expect the U.S. to attempt some very extreme things and expect them to get some of what they try for. So that's, it's in general how politics usually works, and more so in Trump's case, because he's kind of an extreme version of that. So the short answer is, they'll get some stuff. I don't know if all of it will be, the only thing I really, really, really hope they get everything that they're trying for is that they're going to stop the wars. If Trump and his people, who want the Ukraine war to stop and the Middle East war to stop actually get that, then good. Let's see them get everything they're trying for, because what they're trying for is a phenomenally good thing, considering where we are right now on the verge of World War III. Most of the other stuff, they'll get a version of what they're trying for, but not everything.
Commercial real estate in the U.S. In big trouble, but you don't hear a lot about it. Is it kind of the bad kid that nobody talks about at the family reunion?
Well, it's just not on most people's minds because most people aren't involved with it. You and I really don't care about the price of the latest office building in San Francisco that just got sold. But what we do care about is the viability of our banks. And that's where commercial real estate comes in, because when you see this massive glut of office space, which makes office buildings much less valuable, and you see them coming on the market for half the price they sold for in 2018, and that's literally the price cuts that we're seeing out there. And you remember that a lot of the paper related to the financing of these big, no longer very valuable office buildings is sitting on the balance sheets of local and regional banks. Then it's easy to envision a commercial real estate bust leading to a banking crisis, which will be a very big deal when it happens, because that'll lead to government bailouts, which maybe put pressure on currencies, and we have that currency crisis finally. So that's why you should be watching commercial real estate, not because you care personally about office buildings, but because of the knock-on effects of a bust in the office building market. And I think that's a real thing for the year ahead. That could very easily become front page news at some point in the second half of 2025.
Bitcoin below $95,000. Is that a concern for people who are into crypto?
Well, I'm not an expert on cryptos, and so because of that, I'm hesitant to talk about them in any kind of a technical way, because I would betray my ignorance in a heartbeat if I did. Having said that, Bitcoin had a really nice run here, and it's gaining some mainstream acceptance. And now we have to figure out what it is, whether it can actually function as money, whether a digital asset that doesn't exist in the real world can be a legitimate financial asset in the world going forward. I kind of think we're going back to a gold standard because we're screwing up our currencies so monumentally, and so many central banks are buying gold, which they understand and which obviously they view as a monetary asset that they can use to back their currency. So we're seeing that happen. Now, on a parallel track, Bitcoin is gaining acceptance as a financial asset that bills itself as a monetary asset. So that's going to play out in the marketplace over the next few years. And I wouldn't venture a guess. I'm sure gold does very well, and it ends up as a monetary metal, and we go back to some kind of a commodity standard because we're destroying the fiat currency standard. I'm sure about all that. What role Bitcoin plays in that process, I'm not sure about, and you'd have to ask one of the guys like Mark Jeftovic or somebody who really knows how this works, where that goes. Fascinating few years from the standpoint of an economics nerd, Changes in the global monetary system are these very big events that don't happen very often. But when they do happen, they're incredibly consequential, and they're incredibly theoretically interesting. And that's what we're headed for right now.
Any big changes in technology that we should be keeping an eye on going into the new year?
Well, tech is doing amazing things. And what that means for investors is a little blurrier right now because tech stocks are just wildly overvalued based on any historical metric. But, an interesting thing that happened in the U.S. election or in U.S. politics is that Congress tried to ram through a continuing resolution last week, which is how they usually run their scam. They wait until the very end, and then they throw every kind of piece of ridiculous pork for their constituents into a gigantic spending bill that nobody can say no to, because if they don't let it pass in Congress, then nobody gets to go home for Christmas. So this time around, Trump had some people in place who were watching and called it out, and it was possible via AIs to summarize a 1,500-page pork fest spending bill into a few pages of bullet points so everybody could see what was in that bill. And I think that's a big part of what killed the bill. You had people in an administration willing to take a government shutdown in order to stop something this horrendous from being passed. And you had broad-based information about what that continuing resolution bill actually was. So AI may have revolutionized politics by making it transparent. And if that's the case, that's huge. That is just such a big deal. We'll have to see how it plays out. And that would be a reason for governments to try to control AI or make it flat out illegal or something, because it's taking away a lot of power from the corrupt people who have been profiting immensely from their own corruption. So we will see, and then in warfare, technology is having a big role too, because we've got basically unstoppable weapons now. And we've got robotics combined with AI creating super soldiers potentially that are like the Terminator. All that stuff's happening out there thanks to technology too. So it is a wild world, Jim. You and I are going to have immense amounts of things to talk about in coming years.
John, where can people follow you?
Well, I'm at Rubino.Substack.com, and my newsletter there talks about actionable advice for navigating all the stuff you and I just talked about. It focuses on commodities investing, but also on shorting and a few other things.
John, thank you so much for being on This Week in Money, and have a great new year.
Thanks, Jim. See you next year.
My guest has been John Rubino. You can find him on Substack at Rubino.Substack.com. Coming up, Josef Schachter next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Josef Schachter, founder of the Schachter.Energy Report online at Schachter.EnergyReport.ca. He's speaking to us from Calgary. Welcome back to This Week in Money, and Happy New Year.
Happy New Year to you, and I think we're going to have ourselves a very exciting 2025. And to all of your listeners, I think that we had not a great year in the resource sector, be it materials or energy, but I think 2025 we're going to come in and get a life of our own, and could end up being in the top performing groups for 2025.
The latest issue of Ion Energy is hot off the press. You have a special offer for our listeners that ends December 31st in a few days. Can you tell us about it?
Yeah, Ion Energy is our macro product, which is the free product. So people who want to keep up with what's going on in the energy sector, it's a complimentary product. They just go to our website, www.Schachter.EnergyReport.ca, and then they can subscribe to the Ion Energy for that free product. But our paid product is the company stuff, where we cover 38 companies, E&P companies, energy service, a couple of royalty trusts. And our team here has a holiday special. So the annual, the code is HOLA24. So holiday annual 24, HOLA 24. And it's $100 off the annual. And for the quarterly HOLQ, $50 off, $249 and versus $299. And for people who just want to get to know the product, go for the quarterly, and then the economic, once you're comfortable, is to go for the annual, which is more economic. And this will be available not just till the 30th. We're going to hold it open till the end of next Friday, due to the person who handles this is on holiday. So we get an extra 3 days because they're away on holiday with their family. So that's great.
President Trump is calling for drill, baby, drill. Could this have an effect on price inflation and the American economy?
Well, the drill, baby, drill, we're producing about 13.6 million barrels a day. The EIA data came out today because of the holiday, and so it's 13.6 million. Exports in the States, 3.7 million. So they're taking Canadian heavy crude, which is over 3 million barrels, but they export the light crudes, which are sold to Europe and Asia, etc. But it was a bullish report today for a couple of reasons, the EIA report, which is why I think the next dip that we get in crude oil could be the final dip, and then we start seeing much higher prices heading into 2025. But the drawdown from commercial stocks of crude oil was 4.2 million barrels, which is a big one, and then total stocks fell 12.4 million. On the bullish side, another one was the product supply demand had picked up 1 million barrels from 20.8 to 21.8, and year over year demand for product, total product, is up 0.3%. If you remember months ago when I was cautious when price of oil was 80 and I said there's a risk of going below 70 because demand in the U.S. was negative year over year, it was a minus number. Now we're at a positive number over the last couple of months. So we're now 0.3% up on total. And finished motor gasoline, which was down even more than the average, is now up 0.3 to 8.86 million barrels, up from 8.83 the year before. So we're beginning to see positive data out of the States. The area that we need to watch for higher prices would be the China market. But on the drill, baby, drill, the industry is very focused on shareholder returns, not on growing production with no look at the economics of what they're doing, which they did years ago. If you remember, it was grow, grow, grow. Shareholders are now saying, no, there's got to be free cash flow. There's got to be return to shareholders via dividends or stock buybacks. So the company's boards are now having to juggle a number of things. So drill, baby, drill will be one of the things that they do. But the only way they're going to do it is if the price is economic and they make a good return on it. You know, Trump's comments of he'd like to see gasoline prices cut in half. The problem is that means oil prices are cut in half. And, of course, then the economics to drill doesn't make sense. So it's incoherent to say drill, baby, drill, and then the price of gasoline should be down 50%. They just don't work. The numbers don't work. And I think the drill, baby, drill and grow U.S. production and become a bigger exporter to get countries off of unfriendly countries in OPEC is what Trump's going to do in the end. And he'll put more pressure on Iran so that their production doesn't get up there. Iran, for example, I'll just pull up the data there. Iran is producing, I think it was 3.4 million barrels. And so if Iran's production gets cut back, I think that's going to be, a big, if they lose 1 million barrels, that's going to be helpful to the price and the supply and demand of the industry. And then the other one that's going to matter is Venezuela. Venezuela right now is producing about 800,000 barrels a day. And if Trump, puts in more sanctions and blockade, then we'll see lower production from that market as well.
During President Trump's first term, the price of crude went negative for a period of time. Should we be concerned that crude oil could see unforeseen volatility during Trump's second term?
Yeah, what happened there, if you remember, we had a very weak economic period there, and the price of oil went down, and then the hedge funds in the UK, especially in the London area, were shorting the price of the nearby contract, and it went to a negative price. In other words, they were being paid to take the oil, and we went to on the next contract, it went down to $6.50, and that was as you know was during 2020, and that was during COVID, and so we had really crazy prices. I don't think we're going to see COVID in the near future again. I don't think we'll see the economy shutting down like we saw then. And the futures exchanges won't be allowing that kind of negative shorting to negative pricing again. So I don't believe we have to worry about that. Could the price of oil go down below 60 if we see any problem, with an economy? Right now, Trump's coming in and he's going to, do a lot on the regulatory side, opening up, New Mexico for more drilling, the Gulf of Mexico, ANWR. So there's going to be the industry. We'll see if the economics are there to drill and bring on projects. I don't think the U.S. will grow production much in 2025 because it takes time to assemble the land, do the technology, the seismic, figure out where you want to drill. Is the infrastructure there? You want the infrastructure in before you start drilling so you can bring it on quickly and make money on it. So I think that we may see 100, 200,000 barrels come on in Canada. You'll see more coming on from Guyana, the big discoveries that Exxon and Emirati has had. But the big thing is going to be if demand grows by 1.4, 1.5 million barrels, we're going to see more than is brought in non-OPEC, and that will leave room for OPEC to raise production a little bit. And then if Trump is aggressive on Iran and Venezuela, and they lose 1.5 million barrels of productive capacity because of it, that just makes the story even better for energy in 2025.
In President Trump's second term, is the war premium in the price of crude likely to disappear?
Well, right now the real only fighting, there's two places. One is, of course, Ukraine and Russia, and of course, the 20th of January, diplomacy may get pushed forward again, and we'll see what happens. That's why I think Putin is very aggressive on trying to push Ukraine out of that Kursk area where they invaded and push them back. They've already gotten back half the land that was taken by Ukraine. They want to push them out totally by the 20th. We'll see if they're able to do that. Of course, we're hearing that North Korean troops on that front are dying, and over 1,100 have been killed. Between the Russian and North Korean troops, that's a pretty nasty war zone. In terms of the Middle East, it's really only the Houthis now. Hezbollah has been destroyed. Hamas is almost finished. Iran can only push the Houthis to attack Israel. So it doesn't have the war premium that it had when, before Hezbollah was knocked out and before Iran fired missiles at Israel and didn't hit anything because of the defensive systems knocked down their missiles. So and also the fact that they couldn't stop Israel from launching missiles and weapons into Iran, that shows that Iran doesn't have the military capability to even take on Israel. Forget about the United States. So I think the war premium, if anything, is $1 or $2. But I'm looking for a low in the next few weeks, $66 to $68, a test of the lows of September, and that will give us another great buy signal. And so you have an advantage of a buy right now for tax loss selling for small and medium-sized companies, and we have a long list of buy recommendations in our SER recommended page, and a lot of these stocks recently, in the last week or so, we're at 52-week lows, and tax loss selling goes through the end of Tuesday, the end of the month. So I think that we're going to see, till the end of the 31st trading day, that we have potential for a little more tax loss pressure. We're holding just over $70 WTI today, so we're talking about $3-4 downside if it happened, and it could happen even into January if we don't have very cold weather.
Do you think President Trump would like Canada to become the 51st state because Canada's resource rich?
Oh yeah, but I think he thinks it'll be two states. It'll be 51 and 52. And, the western part of Canada will be the Republican, let's say the equivalent of the Republican Party areas, just like the Midwest was and, Texas, et cetera. And eastern Canada will be like the coasts are for the Democratic Party. So it'll be, the Democrats versus the Republicans or the Liberals versus the Conservatives, for 51 and 52. I think it's just he likes to throw a lot of garbage at things and upset people, and he doesn't like Trudeau. So saying you might be a governor of the 51st state, I just think he was just trying to get under Trudeau's skin and let Trudeau realize he doesn't have too many bargaining chips when it comes to what America is going to want. An America First policy going forward after January 21st.
It looks like President Trump plans to clean up the corruption and dysfunction in government. Could this have positive or negative effects on the energy markets?
Well, the Biden administration put in so many impediments to the conventional fossil fuel as they moved towards all these clean tech, support and giveaways. So removing reversing the policies of no drilling in New Mexico on federal lands, less drilling on the Gulf of Mexico, no drilling on Alaska, Anwar, or other places. Removing those policies or reversing those policies will open those lands to exploration and bringing on more production. Of course, Alaska is a Republican state. They want to see more development, more drilling there. They have pipelines that can handle 2 million barrels a day, producing only 500,000. So there's lots of upside from infrastructure there. And so I think that the dysfunction in government will get changed by executive order sometime on the 20th, some on maybe the day later, the 21st. But the corruption, which is the Doge argument, and the Democratic embedded neocons who are effectively running the government now that Biden has been an absentee president, and even the last couple of years when he was not functioning well. So the neocons are still anti-Russia, anti-China, and are saber-rattling for war, and it's pretty clear that Trump is anti-war. So I think the corruption on that side will get taken, they will go after. But, remember, the deep state is pretty deep. It's levels of bureaucracy, and once these new leaders get approved by the Senate, getting in there and putting in good people and cleaning out the mess will take time.
In North America, are we in a recession, or could we be heading for one, and what could that mean for energy?
Well, that's why we had the negative comparisons earlier in the year, because there's really two Americas. There's the wealthy and the upper middle class who own stocks and who own houses with no mortgage or low mortgage. They have seen their wealth go up, and they've been spending, and all the high-end retailers have enjoyed that. And then you go to middle America, and they're hurting. The cost of everything has gone up. Food and their housing and taxes and insurance and all of those things have gone up, and so they're being squeezed. So they're not enjoying the last couple of years. So you have a recession for some and a pretty healthy economy for the wealthy. The question is what happens in 2025 in terms of what does that mean for energy. Those who are lower income are spending less on energy because they can't afford it. Trump, of course, calls for a cut in half in the price of crude. Well, there's no way that can happen if he wants drill, baby, drill. It's an oxymoron to assume, that they're going to be incentivized to drill and bring on more production when they're going to get half the price. It doesn't work like that. It's not like a manufacturing industry where if you remember for the semiconductor, was it Moore's, for Intel, Moore's calculation that the prices can always go lower and lower and you can charge less. Well, that's not the same thing with crude oil. Capital costs are very high and rising, it's not going to be so easy to get lower energy prices. So I don't believe we're going to go into recession. I think that the big surprise for the new Trump administration is, did the Biden administration cook the books in terms of what they used in the calculations for inflation? What did they use in the calculations for employment? The JOLTS report, which is the job openings, have fallen sharply. Is that a more realistic idea of what's going on in the job market? The next few months, if as the new people get in, and the definitions that they use for the creation of these numbers have changed significantly from the last few decades, as they try to throw out some of the high-cost items that don't include others. And there's a group called Shadow Statistics for the U.S. that says the inflation rate is not the 2.6, 2.7 that the Fed is using, but it's more like between 8 and 10%. if you include the same basket that you did 10 years ago. So I think we're going to be there's going to be a bit of a wake-up call, and the Trump administration is going to realize they got snookered on the economic data, and they're going to have to get in there and say right away, hey, this place has been rigged, and it's going to take us longer to get us back on track. We will make America great again, but it's going to take longer given the mess that they gave us.
U.S. long-term Treasury yields have been rising. What's causing this, and what could this cause?
Well, there's questions, as I mentioned, about inflation. There's also the massive deficits. The first 2 months of this year, the amount of the deficit was twice, or it was bigger than the revenues that came in, so that the total spending was twice what the revenue was. At 1.3 billion of spend, 1.3 trillion of spending with only 600 billion of revenue. So it was just obscene what's going on, and that means a forecast if this continues. Because getting cuts out of Congress is not going to be very easy. They couldn't even get the debt ceiling in the last deal. We're talking about a potential this fiscal year of $3.5 trillion deficit versus $2 trillion in the year before, and then that would be a problem for the bond market. And then Treasury is going to have to refinance $5 trillion of debt that's already out there that matures during fiscal 2025. So between raising new money for the new deficit of 3.5, whatever the final number is, and $5 trillion of renewals, that's a hell of a lot of money to try to get out of savers. And they can do a lot of T-bills in short term, but can they sell 10-year paper, which is why we saw the 10-year get up to 4.6 from 4.1 in just the last couple of months. And you're seeing rates in Europe skyrocket, France particularly, because of all the budgetary problems they have. Germany's not having a great time either, and government there has been thrown out, and elections have been called. So, I think what we're seeing now is, remember, Greece was the wounded child of Europe. Now French yields are higher than Greek yields because Greece seems to have gotten themselves back on track, while France has gotten worse economically. And so yields are going up around the world, and the question is, who's the buyer? If China is selling U.S. paper, which it is, the biggest owner now is Japan of U.S. paper, and then, of course, short-term it's T-bills and money market funds. But if they need to refinance 5, 10, 20, or 30-year paper, you're going to need real buyers, pension funds, and if they see that the yield is less than the inflation rate, they're not going to want to buy that paper, which means yields have to go up to attract them. And that's the risk to the U.S. economy, is rising interest rates will hurt the real estate market, housing, and it'll also mean the amount of money that the Treasury has to spend out of their revenues for interest payments. It's now $1 trillion of the amount coming in is being spent to pay interest. If interest rates go up and the cost of money goes up for the deficits and the $5 trillion of renewals, that just makes that burden even more painful.
Are bank failures a concern in the U.S., and can they affect energy markets?
Well, what's interesting is both the Bank of England and the U.S. Fed have now said that they're not going to tell you when there's bank failure. If you remember, when we had the Sovereign Bank of California and others that went under, and then they had to force mergers going back, was it 2 years ago, I think. They're not telling anyone now in either country if there's until after the deal is done, and they've got to either they clean them up and the government owns them, or they're forced into a merger. So because they don't want to scare the markets. To me, the fact that they're not willing to tell you should be scary, because if they aren't able to clean them up, then that's going to be a problem, and then the smaller banks are going to have a harder time getting deposits. The only way it affects the energy markets would be if banks in the energy-producing areas of Colorado, New Mexico, and, of course, Texas were impacted. And if those banks couldn't lend, then that could affect the energy markets, where if they can't give loans and the companies can't spend money on drilling and can't make payroll, and then all of a sudden you have less activity, which would push the price of oil up, not push the price of oil down.
President Trump is threatening Canada and Mexico if they don't stop the movement of migrants and drugs, especially fentanyl, across the U.S. borders. If Canada and Mexico refuse to stop the migrants and the drugs, are energy markets likely to be affected?
Well, let's talk about the first part. I think we've already seen that the president, the new incoming lady president of Mexico, said that they're going to, slow down the migrants coming through, and they were going to put them in camps and be ready also to accept those that are Mexican that are being sent back from the United States at some point. Once Trump gets all the approvals through Congress and moves on that. The fentanyl is another one, and there's two parts to it. One is the drug gangs have weapons coming in from the States. So just like, United States wants fentanyl to stop coming across the border, Mexico wants guns not crossing into their border, that the gangs are, can take on the military and the police, and they have higher and stronger, more deadlier weapons than the police and the troops. So it's a two-way street here. If America wants fentanyl out, they've got to stop the crossing of the border of weapons. In Canada, I think it's fentanyl coming in, and we have a more porous border. So I think using drones and more military and all the things that the government has recently proposed, they're going to have to be more serious about it. But if they did it, that would affect it. In terms of does this affect energy? It affects the economy. So if the economy is, if there's more money being spent on border patrols and all the things needed to protect the countries, that just means more energy use. So it wouldn't affect it negatively. It would be a bigger consumer of gasoline and diesel and, going forward.
What's OPEC up to?
Well, OPEC wants to cut, bring on 2.2 million barrels of more new production, but they're being held back from doing that by, the fact that their inventories were pretty reasonable and demand wasn't as big as OPEC thought. Originally, at the beginning of this year, when we were in the 80s, OPEC was expecting demand to grow by 2.5 million barrels a day in 2024. They've lowered their number consistently in the last 6 months. Now they believe it'll be 1.4 million. I've been in that 1.4, 1.5 all year. So we were at 85, if you remember in our previous discussions months ago, I said I thought there was a risk of going below 70 because you had negative comparisons for the U.S. and negative comparisons for China. Now you've got them at 1.4, 1.5. In 2025, they're looking for a 1.4 number. I'm more optimistic. I think in the second half of 2025, we're going to see prices do even better. And I'm in the camp that's looking for, the price of crude in the second half of 2025, more like Q4, to be over $90 a barrel. So, from 70 now to 90 in Q4 of next year. That's going to be why I think energy and all commodities, nickel, aluminum, rare earths, lithium, all are going to be in stronger demand because we're going into a period where supply is going to be below the demand, and that's going to cause much higher prices going forward.
Is there an inverse relationship between the price of crude oil and the U.S. dollar, and is the U.S. dollar likely to remain strong?
Yeah, it historically, when the dollar was strong, the price of oil was low, and you could argue $70 versus 85 earlier in the year. With the 7-8 cent rally in the U.S. dollar, that has some pressure on the price of crude oil. If we have international disruptions, if we have weak economies in Europe, if we have any problems in Asia with China and Taiwan or the Philippine Islands, then international money flows are going to go wherever it's safest, which means into the U.S., and they would go into the short-term money market. So that's why you might see T-bill rates get lower as the money flow comes in, but the long rate will stay high because people aren't going to be wanting to buy 10 and 30-year paper. So you might see significant money flows if all of a sudden people get worried about things in Europe, or if they get worried about things in Asia. The money flows from those countries will go to wherever they perceive as the safest, which could be the U.S. dollar.
Do you have a bullish case and a bearish case for the price of crude in 2025?
Yeah, the bullish case is the one I've been talking to you about, demand picking up and economies doing better in the second half of 2025 and getting over 90. The bearish case is if we do see that inflation is rampant and we see consumer demand for energy come down because of budget constraints and rising interest rates, and if the Fed goes from cutting like it did the 25 basis points to sometime in 2025 raising interest rates, all of that could throw things into a tizzy. Also, governments around the world, we're seeing polarization either to the extreme right or extreme left. And if that happens and people get worried about the political situation, then you could see economies weaken, and if the tariffs come in and they're serious, think about Germany. It's a manufacturing country selling us cars and industrial goods, and all of a sudden, if there's a 25% tariff, there's already problems with Volkswagen trying to tell its employees, hey, look, with EVs coming and the China, EV, monster coming at us, we have too many factories producing conventional, we have to cut jobs. Well, the unions, of course, don't want that. So, you could have labor strife in a lot of countries where, just like we went from the buggy to the car, all of a sudden a change in terms of technology is going to have disruptions on workers, and this could be very serious. And and AI is still to come in terms of day-to-day uses of AI. That could be disruptive in terms of jobs as well in manufacturing plants and so many things. So you go to McDonald's now, you put your order in on a computer. You're not talking to an employee except to pick up your food. So those kinds of things will create less jobs, which of course is going to be tough on an economy where you try to find jobs for those people, and not all of them can be trained into AI scientists.
Do you have a bullish case and a bearish case for the price of natural gas in the new year?
Mother Nature, weather. The bearish case is that we don't have a cold winter. Right now you do have cold weather in Europe, and storage is coming down pretty quickly. European prices are $15 to $17 U.S. for the price of natural gas in Europe. Asia's between 13 and 15. U.S., I think we saw $3.50, $3.60 U.S. And in Canada, we're really the bad apple in terms of pricing. We're $1.70, $1.80 Canadian. So, that's what $1.20, $1.30 U.S. So it's pretty shabby here. The bullish case is that, January, February, usually when the weather really gets cold and we have big drawdowns, that can help us. The EIA report today showed a 93 BCF drawdown. So, we're getting winter drawdowns, but we need more than 200 BCF for a couple of weeks in a row. And that would help the bullish case for natural gas in the States. And in Canada, we need LNG Canada coming on, which is a Q2 2025 item. So at the end of Q2, heading into Q3, we should see another 2 BCF of demand. That should tighten things up in Canada, and we should be able to see prices move up. So if the American price is, let's say, $3.50, we might see $3.50 Canadian, and that difference would be the 1.44 exchange rate issue, which covers transportation and the fact that we still have maybe too much natural gas in Canada at this time. But as more of the projects get approved up and get the FID and go ahead, things will tighten up. And I think by the end of the decade, as we see more and more exports, and potentially by the end of the decade, we could have 6-7 BCF of exports. Compare that to 17, 18. That's a big number. So I think that's going to be very helpful for the bullish case. The bearish case is we have sloppy weather here. We don't have a cold weather stream. Price of natural gas goes down, after January, February, winter being over, and we have sloppy prices in Q2. That's the bearish case, and it's more bearish for Canada than it is for the States.
Could 2025 be a good year for commodities?
I believe so. That's my view, and I've been, going around in my presentations and speeches talking about 2025 being the year, because I believe we will see economic growth. I do believe China will get its act together, and if the United States under Trump decides that they're going to be tough on Iran and Trump will be tough on Venezuela, remember they've got a navy pretty close to Florida that could go down and blockade Venezuela and say, look, if you don't allow, if you don't have fair elections, or if you don't allow in the opposition to be part of the government, we're not going to allow any ships to come in or out. They were able to blockade Cuba and Russia back down. I think if they blockaded, Venezuela, which should be easy to do, you don't need a lot of aircraft carriers. You can be doing that with destroyers and frigates. I don't think it would be very long before Maduro comes to the table, and potentially, he's given, maybe he gets a trip to Russia so he can live in the same compound as Assad.
Can you tell us again about your special offer and where our listeners can subscribe?
Yeah, we cover 38 companies, both E&P, domestic, international, energy service, and a couple of royalty trusts. So people who need large cap coverage or dividend income, we cover companies right across the spectrum. And there's massive opportunity now with the stocks having come down. So all you need to do is go to our Ion Energy, and in there in the report it covers the specials, and the annual offer, which is $100 off the normal $9.99. The code is HOLA, so Holiday Annual 24, HOLA 24, and $100 off on the annual. And the quarterly is HOLQ 24, which is the $50 off the quarterly, and it'll be available until the close of business on Friday, January 3rd. So people will have quite a bit of time to take advantage of it. If you're trying to just dip your fingers in and see how good is the product, take the quarterly, and then once you see the benefit and you're using it and you're making money from the ideas, switch to the annual, because the annual is the better deal economically.
Joseph, thank you so much for being on This Week in Money, and have a great New Year.
Thank you so much, Jim, and you and all your listeners. Happy, healthy, and very successful and successful investing 2025.
My guest has been Josef Schachter, founder of the Schachter.Energy Report online at Schachter.EnergyReport.ca. He was speaking to us from Calgary. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Rick Ackerman, John Rubino, and Josef Schachter. And thank you for listening. If you have any questions for the show or for our guests, you can send them to info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.